When stock prices feel too high, your common sense screams danger. It tells you to sell now before a crash wipes out your savings. But what if that fear costs more than the potential drop? We are here to reframe this anxiety not as a sign of immediate ruin, but as a trade-off between future returns and present certainty. The data suggests that how long you stay invested matters far more than the price tag at which you enter the market today. Consider the nature of valuations themselves. When we see stretched multiples on stock indices, it is tempting to view them solely as an overpriced bubble waiting to burst. However, historical evidence points to a different reality. High valuations function primarily as a duration trade-off, where the certainty of near-term returns is exchanged for long-term compounding potential. In simpler terms, paying more today means you are betting on higher future earnings growth rather than demanding immediate cheapness. This dynamic suggests that the risk associated with entry price is not about an inevitable crash, but rather a function of your investment horizon and whether your timeline allows enough time to ride out volatility. This shifts the conversation from timing the market to mastering patience. We often hear warnings that buying at all-time highs guarantees poor returns for years or even decades. Yet, rigorous analysis indicates that portfolio drawdowns are driven more by the sequence of returns during the holding period than by the valuation multiple at the time of entry. This effectively decouples stretched multiples from immediate portfolio failure in a way most investors do not realize. A market can remain expensive for a long time without crashing if the underlying economy continues to grow and generate cash flow. The pain comes not from buying high, but from selling low during the inevitable volatility that follows any period of rapid price appreciation. Quick resource note: I keep a curated set of Amazon search links in the description for books, gear, and tools relevant to this channel's topics. Some are affiliate links, so I may earn a commission at no extra cost to you. Please consider supporting the channel by using those links if you find something useful. To understand why this happens, we must look at what actually drives these repricing events in our modern economy. Market movements driven by shifting macro narratives, such as new technological paradigms like artificial intelligence or changing debt dynamics, act primarily as volatility triggers rather than fundamental value destruction. These shifts cause prices to fluctuate wildly based on expectations of the future, but they do not necessarily erase the underlying wealth creation potential if that growth thesis remains intact over a multi-year window. When investors panic at high valuations, they are often reacting to short-term noise while ignoring the long-term cash flow engines powering these companies. This perspective challenges the fear that current market levels signal an imminent collapse of financial stability. While some reports warn about the risks posed by opaque interconnections between institutions and shifting expectations, the core mechanism for individual investors remains rooted in duration rather than entry point. The risk is not a sudden crash, but a period of stagnation or volatility where paper gains fluctuate. If you hold through this uncertainty with a multi-year plan, these periods often become opportunities to accumulate assets at better relative prices during temporary dips caused by fear-based selling. The evidence supports the idea that missing out on future gains is statistically more costly than enduring high valuations for a time. History shows that investors who stay fully invested despite stretched metrics tend to achieve similar long-term outcomes as those who timed their entry perfectly, provided they do not abandon ship when volatility spikes. The difference lies in psychological endurance rather than financial mathematics alone. By accepting that high prices are the price of admission for future growth, you align your strategy with the historical reality that time is a more powerful force than valuation multiples. This approach requires redefining what safety looks like in an investment portfolio. Safety does not mean avoiding periods where stocks look expensive. It means having a financial plan robust enough to withstand those conditions without forcing a sale at the worst possible moment. When you understand that repricing events are often volatility triggers rather than value destruction, you can separate your emotional reaction from your long-term strategy. The market may punish impatience with lower returns over time, but it rarely punishes conviction and duration if the underlying economic fundamentals remain sound. Ultimately, the decision to stay invested during stretched valuations is a bet on the future growth of earnings rather than current price levels. It acknowledges that while high multiples reduce expected short-term gains, they do not guarantee long-term losses for those with sufficient time horizons. The trade-off between present certainty and future potential is real. but it favors staying engaged over retreating based on fear. By focusing on the sequence of returns during your holding period rather than the valuation multiple at entry, you position yourself to capture compounding growth regardless of where prices start from today. Thanks for watching all the way to the end. I am a one-person team working hard to make each video better than the last. Subscribe if you found value. It is the best way to show support. Drop a comment with your biggest takeaway. See you in the next video.